Hello, my name's Ben Kingsley and I'm going to be introducing Jeremy Shepherd, who's going to take us through a case study example of the power of the brand new sell or hold property research platform. Now, it's important to understand currently where the marketplace sits, there are over 10.1 million residential dwellings, and in fact of those dwellings, some areas and locations could be oversupplied, or they may not have any demand at all, meaning that property values may not grow over the next several years, and in some cases, they may even decline. Now, what does that mean for you? Well, that's really important. You want your investment money, whether it be investments, properties, or owner-occupied properties, to be working hard for you. You don't want to be throwing good money at bad. And this analysis is all about identifying whether you should hold on to that property or whether you should sell. So I encourage you to work out, is your property in the wrong location? And if it is, should you sell or hold? So introducing Jeremy Shepherd to take us through the case study example. Hi, Jeremy.
Great, thanks Ben. Straight after login, you'll see the My Properties page. It lists all the properties you're currently analysing. Here you can see I've already added 3. In a minute, we'll examine the second one. But before we start, I just want to clarify the basis for how sell or hold works. Sell or hold firstly estimates how much it will cost to sell your property. That's things like the selling agent's commission, capital gains tax, etc. These are called exit costs. It then estimates the cost to re-enter the market, that is to buy a replacement property. These are called the entry costs. Now, the sum of exit and re-entry costs are called recycling costs. That is the total cost to recycle your equity out of one investment and into another. Then sell or hold forecasts future profitability of your existing property and compares that to a potential replacement. This is called the opportunity cost. That is what you'd be missing out on. If the opportunity cost is considerably more than the recycling cost, then there's a good argument to sell and buy elsewhere. If it's the other way around, you'd probably be better off hanging on. Anyway, that's the basic concept. All the system needs from you is details about your property and what's most important to you, for example, growth or yield. More on that later. Now, one other thing before we start, there's a tremendous amount of online help in case you get stuck. Check out the overview, tutorials, frequently asked questions, and there are other video tutorials like this. All right, let's get started by returning to that list of 3 properties. We'll examine Unit 23 at 4 Case Study Court, which of course is a fictitious address, but it is a real property market. We'll assume this property was bought about 5 years ago and has shown disappointing growth of, let's say, about 1% per annum over that time. Now, to edit the property's details, you simply click on the property name. This will take you to the property details page. You can see I've already entered the details about this property, the first being its estimated value. Now, I'm not going to explain every field and feature on this page. There are other help pages and tutorials that do this. Instead, I'll focus on the key calculations of this specific case. But I will mention that each field label contains an information icon you can click on to get more info. The system gauges performance of this property by looking at a few things. One of them is rental income, which you can see works out to be about $24,000 per year, and that's based on a $475 per week rental income and some vacancy rate, which the system defaults for you from current market data based on this type of property in this suburb. Expenses also need to be considered. You start by entering the loan size and interest rate. If you have money in an offset account, enter that amount. Now, if you're unsure about what a field means, just click on that information icon beside each label. The system also needs to know the management fees, insurance, council rates. Some of these are defaulted by the system to save you time. Now, you might need to pull out rental statements and loan statements to find all these values, but it is time well spent since, remember, you're making a decision regarding hundreds of thousands of dollars, right? You can collapse sections to simplify the view. You can see that this property is negatively geared since income is exceeded by expenses. And as you can also see, this property is costing the owner what works out to be around about $3,000 each year. That means capital growth has to exceed this amount by at least the rate of inflation to make it worthwhile owning. All right, scrolling down further, we come to the exit costs section. The cost to sell this property and exit the market is called the exit costs. Now, the two biggies will be the selling agent's commission and capital gains tax. The system defaults the selling agent's commission, but you might like to check with local agents for a more accurate figure. Capital gains tax is a complicated issue. Fortunately, the system performs these calculations for you. All you need to do is enter values into the fields. You should check though with your accountant if you think your circumstance might be a bit peculiar, since there are loads of special rules that apply to capital gains tax. One of the biggest stumbling blocks will be depreciation. This is where the information icon becomes invaluable. A click on the More link takes us to a detailed explanation of what depreciation is, how it's relevant, and how to obtain a figure to enter. Depreciation claimed to date comes off the cost base, which increases the capital gains tax liability. But things like stamp duty and some other acquisition costs go on to the cost base. Note that you can offset capital gains from the sale of a property against capital losses from the sale of another asset, for example shares. All you have to do is enter a negative value here. Alright, once the cost base has been calculated, the capital gains tax is calculated, and the system now knows your total costs to exit the property market. The system also knows how much money you'll have after the sale. The net amount is called the post-tax sale proceeds. These are the funds that go towards the deposit on a potential replacement property and other entry costs like stamp duty, legal fees, inspections, etc. If you had some money in an offset account, this will be released on the sale of the property. So this is included also. Now, the next two fields are not relevant for our simple case and are better explained in the help pages, so I'll gloss over these for now. The loan to value ratio, or LVR, is an important figure here. The system defaults the LVR to 80%, which is conservative and quite common for many investors. Consult with your lender or mortgage broker before changing this value. Similarly, you may be restricted on how much you can borrow, so again, ask your lender or broker. All right, moving on, there are costs associated with re-entering the market again, that is buying a replacement property. The biggest cost will no doubt be the stamp duty. Fortunately, the system provides an estimate for that. There are a bunch of other costs too, most of them defaulted by the system. At the bottom of the page, the system has estimated the target replacement property's price. This will be used in the next phase. The last two fields are defaulted by the system. They determine the expenses of the replacement property and the rate at which expenses increase over time. I'm going to leave them as is since I think they're good defaults. Once all the values have been entered, you can now move on to the next phase. You can come back to the property details page later if you need to make adjustments. All right, what we have so far in summary is we've got income calculated on an annual basis, expenses too. We've got the total costs summed up to exit, that is to sell the property. We've got the net sale proceeds, which is what we'll have in our hand after we've sold. And we've calculated the costs to re-enter the market, that is to buy a potential replacement property. And the system has been able to estimate what the price for that property will be. Now, you might like some of these calculations that the system has performed so far, but the true power is seen in the next phase, where the system scans the entire country looking for suitable alternative suburbs within that target price range. Click this button to proceed. This page is called the Alternatives page. It's called the Alternatives page because it shows a list of alternative markets, but it starts off showing details about your current property and its market. Now, there's another video tutorial walking you through all the features of this page. I won't repeat that, I'll just focus on some of the key figures. Now, the first thing I want to point out is that the demand to supply ratio, or DSR for short, is only 47 for this market. This is a score out of 100 for the level of demand relative to supply. Anything less than 50 is a bit of a worry. The next column shows the confidence we have in this figure of 47, and it's also a score out of 100. So you can see that we're quite confident that demand in this market is exceeded by supply. The The next column shows how many other property markets we've seen in the past with the same demand to supply ratio. If the number of historical cases is in the thousands, then we've got a lot of data we can draw from to come up with a more accurate forecast of future growth. The yield I'm sure you're already familiar with, and the net post-tax sale proceeds were covered in the property details page. The 3-year net position is calculated by forecasting growth, adding that to rent, and then subtracting expenses from that over the next 3 years. This is effectively what your property will earn you. So in this case, we're looking at about $20,000 being earned over the next 3 years. Not very impressive, right? ROE stands for return on equity. It's a reflection of how well your money is allocated. All right, let's move on to the alternatives table. This is where the true power of the system shines through. Using the target price range calculated earlier, the system has scanned the entire Australian property market looking for suitable alternative suburbs. These are listed in this table along with a few key metrics. Now, some of these I've already explained, so I'll just cover two, the spare funds column and the 3-year better off buy. All right, different property markets have different prices and different states have different stamp duty rates. After paying a deposit, stamp duty, legal fees, inspections, etc., you'll have a certain amount left over, and this is estimated in the spare funds column. Now, the 3-year better off buy column is really important. It is the difference in performance forecast for your existing property and the alternative one. The growth, rent and expenses are estimated 3 years into the future and compared. The cost of selling your existing property and buying the alternative is factored into this calculation. Now, the table of alternative markets you see are sorted by this column from highest to lowest. This is the default sort. But you can sort by other columns by clicking on that column's header. Now, the system wants me to pick one of these alternative markets. The alternative I select will then be compared with the current investment property to gauge opportunity costs and to generate an assessment report. Now, I'm going to accept the default sorting since I want to be better off by as much as possible after 3 years. However, I'm not going to pick the very top location. I want a little more cash left over after as an expense buffer. So I'm choosing this one. I'm choosing Charnwood. This will leave me with almost $30,000 safety margin for emergencies. Now, once you've selected an alternative market, its details are shown under your current properties market for easier comparison. Now, you can change your mind later about which alternative market to select, but at this point, everything is ready for me to generate a report. And the report will compare my current investment property to the property market I just selected. And I click on this button to generate a report. After a brief introduction, the report starts off with the executive summary, which might be a bit much to take in the first time, but if you're in a rush or familiar with the terminology, it's a great time saver. The charts are the interesting part. The first one shows a horizontal line, which is the recycling cost, the cost of selling and buying again elsewhere. You can hover your mouse over the parts of the chart to see more detail. Now, the bars show the opportunity cost rising as the alternative property starts to outperform your existing one. In this case, it takes only a single year for the opportunity costs to exceed the recycling costs. That's quite a strong argument for selling, since normally you wouldn't expect recycling costs to be recouped within the first couple of years. The second chart shows the net position for each year. It starts off in negative territory until the recycling costs are recouped. The bar for 2019 shows we're in front after just 1 year by almost $37,000. After the executive summary is the table of contents. There's a great section on terminology, followed by an explanation of how your property is assessed in the report. But part 2 is where your specific property's analysis starts. The first thing the report shows in this section is the recycling costs, which are broadly broken down into exit and re-entry costs. The rental income is assessed, which is pretty simple, and then there's a breakdown of your holding costs. Then comes an explanation of the replacement target price range and your re-entry costs. The markets from the alternatives page are displayed with the market you selected highlighted. If you scroll down, the comparison between your existing property market and the alternative you selected begins. This chart shows a comparison between the relative demand and supply ratios of your current properties market and the alternative. The Australian average is shown as a benchmark. The grey shaded region shows the range from best at the top to worst at the bottom in terms of supply and demand for all property markets around the country over the last year. There's also a chart showing how prices have changed for both your current properties market and the alternative over the same time frame. The next table is pretty interesting. It contains the key metrics involved in the demand to supply ratio for each market. And then we get on to the forecasts. Now the first chart compares the forecast price increase over the next few years for the alternative property market in blue and your current properties market in aqua. Now the forecasts are shaded to show that a range of values is possible. The upper edge of each triangle is the optimistic growth. The lower edge is the pessimistic growth. Most markets should have growth somewhere between the upper and lower edges. If the alternative market's pessimistic forecast is above the optimistic forecast of your current property market, then there's a good argument to sell. If, however, there's a considerable amount of crossover in the shaded sections, then there's a good argument to hold. You can hover your mouse over parts of the chart for more precise figures, but these are tabulated below the charts anyway. Now the same thing is done for rent forecasts and expenses to come up with a net forecast, which also factors in the recycling cost. That's why the alternative market starts with a negative figure. The next section is one of the most important of the report. It provides some tremendous insights into the comparison. Read through each paragraph carefully. The symbol to the left gives an idea of the overall assessment for each paragraph. The same charts as we saw in the executive summary are shown after. And the report finishes off by suggesting further research you can conduct if you're still unsure about the observations presented in the report. And warnings are well worth considering too. Now you can gain a copy of a sample report like this one to take a closer look at everything that a report contains. There will be links around the website on how you can get a copy. Now from here, you can return to the alternatives page to select another property market and generate a new report, or you could return to the property details page to adjust values you've entered for greater accuracy.
Well, thanks very much, Jeremy. I mean, it just goes to show you the amount of insights that you can get from detailed analysis. I mean, we just saw in that example the significant financially better off position that example showed. And that's what sell or hold is all about. It's about making sure that your money is working as hard as it possibly can for you, to stopping you from throwing good money at a bad investment. Doing that analysis and then potentially going back and looking at other alternative markets is going to help you to make a more informed decision of whether you should sell or hold. And that's exactly why Jeremy has spent over 2 years in developing out this fantastic research platform. So we encourage you to take advantage of this tool and find out whether you are in locations where it's better off for you to sell, or if it's better for you to continue to hold and then move on with your investment strategies. Thanks for watching.